Welcome to the deep dive. Today, we're cutting straight to the chase. We're looking at how you can potentially gain profitable long-term investment insight and the kicker. With minimal stress, maybe just dedicating like an hour a week. Sounds a bit like a fantasy, right?
It really does. But there's solid research behind it.
Exactly. Our whole mission today is looking at Mark Shipman's work, specifically his book, Big Money, Little Effort.
Yeah.
Now, the core idea itself is, well, compelling, but it's the author's background that makes you sit up and listen.
Oh, absolutely.
Shipman left school at 16, hardly any qualifications, gets a job in a bank's post room back in '79.
Yeah, the classic rags to riches story.
And then just shoots up the financial ladder. It's quite the journey.
It really is. And that foundation is, I think, key to his credibility. He didn't start with privilege or a fancy degree. He learned it all on the trading floor, got into futures contracts.
And he proved himself globally, didn't he?
He did. Won the World Professional Futures Trading Championship in 1991. Then, just 2 years later, people were calling him a leading money manager. But the most important thing, for me anyway, he quit fund management in 1996. He was only 33.
33. Wow.
So he could focus only on managing his own money, using these exact methods we're going to talk about.
Okay, so this isn't just theory. We're actually dissecting the system a world champ trader uses for his own fortune. Our goal then is to unpack this promise. High-level success, little effort, maybe an hour a week, using a system he claims is straightforward, manageable, and crucially, stress-free.
And, to really get why that simplicity is powerful, we first need to grasp the flaw Shipman sees in the financial system, his main criticism. It's aimed squarely at education, or the lack of it.
How so?
Well, the average person just isn't taught basic money management or investing skills, and that vacuum. It leaves people vulnerable to bad decisions and frankly opens the door for the financial services industry to, well, exploit that lack of knowledge.
Which leads straight to his pretty bold claim that you, the individual investor, can actually beat the professionals. Hang on, though. We pay these experts, right, for their expertise. Yet Shipman's sources suggest, what, 80%, maybe even 90% of fund managers fail to beat their benchmark index long-term. That sounds counterintuitive. Is that figure skewed, or is their job just that hard?
It's mainly the constraints they operate under. You're paying high fees, yes, but the pro often has like both hands tied. They're restricted. Maybe they can only invest in certain sectors or certain countries.
Right.
And here's the big one. Minimum stock exposure rules. They have to stay invested pretty much, even when the market's clearly heading south.
Oh, I see. They can't just bail out.
Exactly.
There was that funny story, well, not funny for the experts, about the 5-year-old girl.
Yeah, the stock picking contest.
Right. The British press set it up. This little girl picking stocks totally at random versus 2 seasoned financial pros. After a year, guess whose portfolio was up?
The kids. Almost 6%, wasn't it? Well, one of the experts lost like nearly half his value.
Over 46% down. I mean, if that doesn't highlight the problem with blindly trusting active managers.
It really drives the point home. And it highlights the individual investor's huge advantage, freedom. You have the freedom to ditch a bad asset and, crucially, the freedom to move all your money into cash if things look bad.
The parachute analogy.
Exactly. It's about protecting your capital. That's the single biggest tool the average person has that the pros often don't.
And Shipman also warns about trusting external advice, brokers, and analysts. He uses the Enron example, right?
He does, a classic, tragic example. You had, what, over 50 major firms yelling buy or strong buy?
Even as the stock was cratering. From $80 down to basically nothing.
Because those firms had other interests.
Yeah.
Huge banking fees, underwriting deals. Their advice wasn't purely for the client's benefit.
And he lumps tied advisors in there, too, basically calling them salespeople.
Essentially, yes. Their job is often just to keep you invested, keep you paying fees.
So we have external risks, conflicts of interest, but then there's the internal battle, too, our own psychology.
Absolutely. And that's precisely why Shipman hammers home the need for a system. We're just not wired for rational investing under pressure. We try to time the market perfectly, buy the low, sell the high.
Which nobody can do consistently.
Right. And the second things get volatile, rationality goes out the window, fear and greed take over, and bang goes the long-term plan.
So the system acts like a guardrail against our own emotions.
Precisely. It's the antidote. Shipman's whole method is based on systematic investing and disciplined market timing. The goal isn't short-term gains. It's about catching and riding those big long-term trends, the ones that last maybe 2-3 years. That's where he says the big money is made.
And that's a direct challenge to the old buy and hold forever
A
mantra.
total rejection of it, really.
He used that analogy, like refusing a parachute on a plane known to crash.
Yeah, powerful image. Sticking rigidly to buy and hold means you're basically accepting potentially massive, unnecessary losses. You're choosing to stay exposed.
And the historical costs of that exposure can be brutal.
Think about it. The dot-com bubble. If you bought and held, maybe you quadrupled your money from 98 to 2000, fantastic. But by 2001, poof. You likely gave almost all of it back.
Ouch.
Or go back further, the S&P 500 dropped 50% between 73 and 74. Imagine riding that all the way down. Market timing, in Shipman's view, isn't about darting in and out. It's about having that parachute ready, protecting yourself financially and emotionally from those sustained bear markets.
And if people need proof that simple rules can work, even better than genius sometimes, he points to that turtles experiment.
Ah, the legendary turtles. Richard Dennis's brainchild.
Right. Dennis was this hugely successful trader, and he had this bet, basically, that trading skill wasn't innate genius. It could be taught through simple mechanical rules.
So in '83, he advertised for trainees, no finance background needed.
Yeah, he got all sorts, didn't he? Security guards, I think a juggler, an actor.
Actors, engineers, yeah, total novices. And he trained them on a straightforward, trend-following system. Completely unambiguous rules.
And the results.
Blew everyone away. These turtles, just by sticking rigidly to the simple system, made millions and millions in profits over the next few years.
Wow.
It proved Dennis's point. Success wasn't about IQ or some mystical market sense. It was about discipline, following the rules, period.
Which perfectly leads us to Shipman's own system for the individual investor. His philosophy. KISS. Keep it simple, stupid.
Exactly. Let's get into it.
So what's the core mechanism? How does it work?
Okay. The long-term investment system, or LTIS as he calls it, is built around a really common tool in technical analysis, moving averages, MAs.
Moving averages. Okay, I've heard of those.
Think of them like this. They smooth out the day-to-day price bumps, all the random noise. They give you a clearer picture of the underlying trend, the market's real direction over a longer period, like a smoothed out line on a chart.
So if the smooth line is going up, things look good. If it starts turning down.
Exactly. If it's trending up, generally safe. If it's turning down, danger might be ahead. It filters out the short-term panic or euphoria.
Okay, conceptually that makes sense. But Shipman promised unambiguous rules. Mechanical. So what are the specific moving averages we need to watch?
It's surprisingly simple. This system uses just two, the 30-week moving average and the 50-week moving average.
30 and 50 weeks. Okay. Why those?
They're long enough to filter out that daily or even weekly volatility. They focus on the intermediate to long-term momentum shifts. That's where the sustained trends live.
Got it. So how do these two lines tell you when to buy or sell? What's the trigger?
It's simply when they cross over each other. Rule number one, the buy signal. You invest in the stock market. This happens when the most recent 30-week MA figure goes above the most recent 50-week MA figure.
So the shorter-term average is rising faster than the longer-term one, showing building upward momentum.
Precisely. It confirms the upward trend is likely taking hold. Rule number two, the sell signal. You move your money to cash. This happens when the most recent 50-week MA figure goes above the most recent 30-week MA.
Okay, so the longer-term average is now higher, meaning the shorter-term momentum has faded, and the sustained trend is probably shifting downward.
You got it. The longer average dominating signals that a sustained downward move is likely underway. Time to get out.
So hang on, it's literally just checking where two lines are on a chart maybe once a week.
That's the core of it, yes.
And your money is always in one of only two places. Either invested in a broad stock market index tracker,
Right.
or sitting safely in cash, like a high-interest savings account.
That's the system.
That really is little effort.
Wow.
And notice the investment choice is simplified too. Shipman strongly recommends using index trackers, like for the S&P 500 or the FTSE 100 here in the UK or the DAX in Germany.
Why index trackers specifically? To minimize security risk. When you buy an index, you're buying the market, essentially. The index itself automatically handles adding successful companies and dropping failing ones. It's like the index provider is doing the portfolio management for you, constantly weeding out the losers and promoting the winners. You don't need to waste time picking individual stocks.
Okay, simplicity is great, but does it actually work? Let's get to the performance, the proof.
This is the really compelling part.
Shipman did backtesting right on the S&P 500. How far back did he go?
All the way from 1951 through to 2007. So that's, what, 56 years of data, a very long period.
56 years, and how many trades did the system generate? Buy or sell signals?
Get this, only 21 positions in total, over 56 years.
21. That confirms it's absolutely long-term. We're not talking about day trading here.
Not even close.
Yeah.
And the results, over 71% of those 21 positions were profitable.
Okay, better than a coin flip. But what about the size of wins versus losses?
That's the key metric. The ratio of the average profit to the average loss was 6.3 to 1.
6.3 to 1. So the winning trades were, on average, over 6 times bigger than the losing trades.
Exactly. The system is designed to cut losses relatively quickly when the trend reverses, but let the profits run when the trend is strong. The biggest single gain recorded was almost 179% on one position between 1995 and 2001.
Let's zoom in on that period you just mentioned, 95 to 2007. That covers the huge dot-com boom and then the bust. How would the system have done then compared to just buying and holding?
Right. A great real-world test. Let's imagine two investors, both starting with, say, £10,000 in 1995, tracking the S&P 500. Okay, investor one just buys and holds. By the summer of 2007, their £10,000 would have grown to about £33,260. That's a 230% gain. Not bad at all.
But they would have endured that gut-wrenching crash from 2000 to 2003, right? Seeing half their paper wealth vanish.
Absolutely. They felt the full emotional roller coaster. Now, investor two uses Shipman's LTIS system. They ride the bull market up. Then, crucially, they get their sell signal sometime in early 2001 near the top. Let's say around the 12 door to 80 level in the S&P.
So they get out, move to cash.
They move to cash. They protect their original £10,000 plus all the profits they'd made up to that point. That cash then sits safely, maybe earning some interest, while the market tanks.
Okay, and then what?
Then they wait. They follow the system. The next buy signal comes along in 2003 as the new bull market begins. Now, they reinvest. But crucially, they're reinvesting a much larger amount of principal, the original capital, plus the protected profits.
Ah, so they buy back in with more money because they didn't lose it in the crash.
Exactly. And by that same point in the summer of 2007, the LTIS investors portfolio is worth around £45,000.
45,000 compared to 33,000 for buy and hold.
Yep, that's a 350% gain versus 230%. About 1.5 times the profit.
And presumably with a lot less stress, having sat out the worst of the bear market.
Dramatically less stress.
Yeah.
Zero exposure to the sustained 2000-2003 downturn. That's the power. Capital protection enables greater long-term profit.
Okay, that's impressive. But let's play devil's advocate. No system is perfect. What about sudden, sharp shocks? Like the 1987 crash. The market dropped, what, 36% in a day or two? A weekly system based on 30 and 50-week averages wouldn't react fast enough for that, surely?
That's a really important question. And you're right, the system cannot react to instantaneous flash crashes. It's designed to ignore that kind of short-term noise. So yes, in October 1987, the system would have been caught in the initial downdraft. It wouldn't have generated a sell signal immediately.
It would have taken a hit.
It would have taken a significant paper hit, yes. But, and this shows the system's resilience, because the underlying long-term trend, the one tracked by the 30 and 50-week averages, was still fundamentally positive before the crash.
Okay.
The system kept the investor in the market. It didn't panic sell at the bottom. And because the market did recover relatively quickly, that position, despite the huge temporary drawdown, actually still finished positive for the full year of 1987.
Oh, really? Even after that crash?
Yes. The key was that the long-term uptrend, according to the system's rules, hadn't been broken yet. So it prevented a panic reaction, kept the capital invested to participate in the recovery. It showed strength by sticking to the rules, even through extreme volatility.
So wrapping this all up then, what's the big takeaway for someone listening? What does this all mean for, the average person trying to invest?
I think the core value here is clarity and discipline. The system isn't magic, it's a tool. It gives you an objective, unemotional way to make decisions. It helps you stay invested during those big wealth-building bull markets, which is where most long-term growth comes from. But just as importantly, it provides that crucial parachute, that mechanism to step aside and protect your capital when those really damaging, sustained bear markets hit. It works well enough, Shipman argues, that a world champion trader trusts his own money to it. That says a lot.
And he's okay sharing it. Doesn't giving away the secret diminish his own edge?
Apparently not. He basically says the market is just too vast. Billions, trillions changing hands daily. Him, you, me, thousands of others using this simple system. It's not even a drop in the ocean. It won't affect the overall trends he's trying to capture. Plus, He seems to genuinely enjoy teaching people.
So what does this all mean for you, the listener, trying to make sense of investing?
Well, it leads to a pretty provocative final thought, doesn't it? Shipman's work seems to prove that the most critical factor for investment success isn't being smarter than everyone else, or working harder, or having some complex algorithm. It might just be having a clear, unambiguous method, any method really, as long as it's objective for spotting those major shifts in market momentum.
Just having a plan and sticking to it.
Exactly. And if the market really is so big that our participation using a simple system like this won't disrupt it, well, does that mean the simplicity of the system makes the only really hard part left? Mastering yourself.
Mastering your own discipline.
Yeah. Can you actually follow the rules mechanically, week after week, year after year, without letting your own fear or greed interfere? Maybe that's the real challenge, not finding the perfect system, but just sticking to a good enough one.